When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio number 34, December 31st, 2024. The end of the year that just cannot go away fast enough. Welcome to all our friends in the MacroEdge team. This is a special program. We're basically going to sit there and have as many members of the team and our listeners who wish to give 2 cents, provide input, make predictions for 2025, or reminisce about the wonderful year of 2024, which couldn't actually sit there and burn in hell fast enough for me. I'm just saying. Just my personal opinion, your mileage might vary, okay? And yes, there is a reason I posted a picture of a book that I have 2 editions of, the 2 different versions from the memoirs of Herbert Hoover. I posted that up on X. We'll get to that in a later program, probably in the first quarter of 2025. I have the feeling it might be pertinent to what's happening. For those of you who are new to this, we've had a massive amount of quality information transferred via this show. We've brought a lot of guests on. We've had a lot of people who work as part of MacroEdge contributing in every way they can. And it really does make a difference when you get a different opinion on what's happening, when you take yourself away from the financial mainstream media, when you take yourself away from the rah-rah FinTwit crowd that every coin that comes out is going to 1 million or every stock that comes out is going to 1,000. When you divorce yourself from the alternate reality presented by these people, you have an opportunity to look at hard data and understand what the MacroEdge team is trying to present. And that's what I think makes a difference, a real difference. And I think that's why you need to sit there, and this is the first plug, there'll be many others. You might want to take a look at MacroEdge Ozone and RE Insights. The RES Insights is fantastic if you read the information, and there's going to be more of it available for real estate professionals. That is where we're going to go. We're going to go with hard data all the time. And if you pay attention to what's being said, it might save you a fortune. It might make you a fortune. We don't offer any guarantees. We simply put the data in front of you for you to interpret and go from there. That's what MacroEdge is all about. MacroEdge.net/ozone for a 2-week free trial. And with that, let's do a year-end market review because, wow, what a year it was. We were told that Santa Claus was going to give us a big rally, but like I said, when Jay Powell stood up before the microphones a few weeks ago, he shot down Santa Claus with a Sidewinder missile, and that sleigh went flaming into the Arctic Circle, freezing the poor reindeer to death. Dow down 29.51 today, NASDAQ down 175.99, S&P 500 down 25.31, Russell up, though, $5. Volume was miserable on the New York, somewhat heavy for the NASDAQ, almost 8 billion shares. Someone started first thing this morning and yesterday with large-scale distribution, and it didn't slow down today. People are getting out of the markets. Don't know why. Well, we have our ideas why, but don't know why that hasn't been noticed by more people. This is distribution. This isn't Aunt Ethel and Uncle Bob selling their stocks at the end of the year for tax profits or profit taking, as the media has been reporting. This is the big boys moving that market, and somebody's getting out of the NASDAQ in a hurry, also getting out of other things and buying some bonds. Despite that, for the year, the biggest reversal was the 2-year, 10-year spread, finishing today positive 33 basis points. That is an indication that we're getting ready to go back to normalization, something that this economy nor the individuals who have speculated in it are prepared to deal with. You're going to see a 100 on this soon enough. You're going to see a full point on the 2-year, 10-year spread. And there is no one, I repeat, no one prepared in the equity or the bond market to deal with that. The 3-month 10-year also got back to positive territory, which is something we were predicting on this show and on other in the writings of the MacroEdge team. It finished at 24 basis points. It's not a huge move, but once it cracks over 25 to 30, it's going to take off like a scalded dog. That's a Southern expression if you're not familiar. And once you throw that boiling water on that dog's butt, it's going to run high and fast and hard. And you will see that easily over 200 basis points probably this year. And that's what should scare the hell out of everyone. It means the 10-year treasury is getting ready to explode. And that yield is something that's going to punish everything in the markets. Gold finished the year at 26.38 today, up $20. Silver at 29.29, down 12 cents. Copper at 402, not confirming the move in gold, although the gold move is being called a move, and just in case something violent happens this weekend on the global scale. Crude oil at 71.75 and Brent at 74.42. The Widowmaker has been all over the place. She's been cutting and slashing and killing people. It's been over $4. It's back down today to $3.62, which means that everyone who bought it at $4.27 got a margin call this afternoon or this morning. Been there, done that. Let us proceed on, though. What are we looking for in 2025? I'll get my brief set of predictions in while everybody tunes in. You can see it on my blog at johngaldfla.com. You'll be able to read it at MacroEdge, but we'll just hit the economic ones. The geopolitical ones are another one. I think natural gas is going to head higher. This is a personal opinion based on the long-term weather models. I see it getting up over 550. I think we're going to have about 60 days of extremely cold weather that is not expected by the mainstream media and will cause mass panic and climate change screaming and all kinds of other insane things from the crowd. Crude, thanks to Drill Baby Drill and a sudden flurry of permits for pipelines, will probably drop as low as $50 per barrel, and Trump, rightfully so, will refill the strategic oil reserve. I can see it doing it, but bouncing back closer to 75 by year end as geopolitical instability is still going to be ruling the roost. Credit spreads are going to blow out, and I don't see the CPI, especially I use the Atlanta Fed sticky CPI, dropping below 3.5% anytime this year. In fact, I see it getting closer to 5% by May, if not well over it this summer. The political instability we see with our friends in Washington will continue. I do believe that we're going to see a very slow start to the Trump administration, a good start from a personnel standpoint. However, undoing what has been done in the last 30 days is going to take a lot of work. What's been done in the last 4 years is going to take more work, not just executive orders. And I can see the Freedom Caucus obstructing a lot of the spending that they want to do unless real cuts are engaged. I also see Doge flopping. I'd love for it to succeed, but I think there's too many egos, too many people saying, look at me. And I believe that what's going to happen is that the relationship is going to have a schism sometime later on this spring, especially when we get into major issues with the equity markets. Excuse me, folks. You have to understand, I have to stay lubricated for this program. It's a lot of talking. So as a result of this, I think we will have some sort of crash in the spring. We'll get somewhere below 4,800. I won't try and peg a bottom, but it'll be a substantial correction. And year end, we'll end up right back where we started, somewhere between 5,800 and 5,900. I think the 10-year does get close to or breaks above 6% before retreating close to 5% by year end due to intervention from the Fed. I think we're going to have some community bank issues. I think it's going to be save the big banks, screw the community banks. And one regional is going to be taken out as on account of this, it'd be forced to merge with one of the big boys. One of the big boys who's not so healthy. Bank of America. Oh, did I say that? Excuse me. We're going to see a lot of retail brick and mortar stores shutting down. My shock prediction is that Amazon buys Walgreens. If anybody wants to ask why, please feel free to. I'll be more than happy to explain that. And I do see gold continuing to progress as inflation stays embedded and the debt problems of the United States and the consumer continue well into next year. And I do mean well into next year. And I don't think there's going to be any kind of let up. I really believe that there's a global wager that our debt problems are finally going to create geopolitical financial issues that have to be taken into account. With that being said, who wishes to be the first of the MacroEdge team to join me today? I'm looking at the board. Anybody want to put their hand up? I'll be more than happy to add you into the mix because we have 6. We have Mr. Austin. Melody will be here later on in the hour. She'll be able to join us in about 20, 30 minutes. We have our friend Market Wizard. If you want to hop in there, just raise your hand. I'll pull the mic up for you real quick. Anybody who has a question or has a comment about last year or this year coming up, please request to become a speaker. I'll be more than happy to put you on the air because this is for us to sit there and bounce ideas off of you, our listeners, and to receive ideas from our listeners. We're going to share this with everyone. We don't want to just simply sit there. Oh, Melody's here now. Okay, I'm going to go ahead and bring her up then. If I can get this stupid thing to work. It's insane. She's got to leave in the next 30 minutes, so I'm going to get her on the air pretty quick here. And we're going to we'll talk housing. I can promise you that. Melody, are you ready?
I'm here, John. How are you?
Pretty good, except I just realized that was my.
I just lost you, John. Are you still there? Can anyone else hear me? Oh.
Oh, there we go.
Can someone let me know if you can hear me? Oh, sorry.
That's okay. You can hear me now, so I think everything's working again. This is the joy of our friends at X.
Yes. Always fun. Always fun.
It never disappoints.
No, it does not.
So, that being said, please give us your insights on 2024 and 2025.
Sure. So, like you, John, I'm really ready to see 2024 pass us by. I've been working on my kind of year-end review and year ahead. That it's really making me think back over what's happened. And when you look at 23 and 24, they were virtually the same in the housing market, which is just wild, right? Because there was so much narrative out there. But in reality, when you look at absolute combined sales together, which is how I like to look at the market, it was basically just a repeat with, highs in certain months versus others, and even with a rate perspective. And so, what I would say about 2024 is that there was much ado about nothing in the press very often. If you guys remember in December of last year when Powell pivoted, everyone thought it was a second coming of the housing market. And he pivoted with his words, right? Not even the cuts. And then you saw again in the summer, everybody fall all over themselves thinking, again, that housing was about to restart. But in reality, we definitely have some pent-up demand. It's not the demand that people think. It's the demand of people that are in a kind of a bind and need to get out. But we're hoping against hope that these rate cuts would mean that someone was coming to buy their home that's been sitting on the market for 6 months or longer, or it hasn't been sitting on the market because they got burned by previously listing it in the spring and seeing that there was no interest. So, we had an unseasonably warm October, but I honestly think that has more to do with we had some more closings that were postponed due to the storms, and we're seeing that kind of in October, November, December. But those lower rates did kind of bring some activity. It brought more listings than it did sales. I think we'll have kind of an okay December, but when I say okay, I just want people to understand that last year we went below 300,000 in existing home sales, which is really, really bad. And that was because we peaked at those high rates in October. And so when I say okay, we're just going to be coming off that bottom again. But I think what you're seeing right now is everybody kind of people are pulling that inventory for the holidays, and also having been burned by those lower rates not coming when the Fed cut, which is I think the greatest irony of all this year. But in the spring, we are going to see listings continue to grow, and I think we're going to see motivated selling turn to distress selling. But I'll stop there, John, before I go into 2025 for any comments. You or anyone has.
Oh, I 100% agree. I think what happened in 2024 is a transition, and I think that something that we've discussed over the programs you've done with our team here is that we witnessed a prayer movement, so to speak, where everyone was praying they could forestall the ultimate day of doom. And by that, I mean,
Right.
we're willing to sit there and buy time in the hopes that 2025 will have this massive, miraculous recovery and geese will lay golden eggs on everyone's house and they'll get current. And same for commercial real estate. It's not going to happen, folks. And we're watching it in Florida in slow motion. But nobody wants to foreclose. But at the same time, nobody wants to accept the bad homes back either. So it's sort of it's a 2009-ish catch-22, if you get my drift.
I absolutely do. And then you add on in it. I mean, what's really funny about this cycle is we've already had GFC style intervention in the mortgage market. And that's what so many people don't understand. Like, they just preemptively did it, which is why we've been able to extend and pretend. And so what's been very interesting about this to me, John, and I'm sure you kind of feel the same because you're a veteran as well, is that we have these mixtures of like 2006, 2007, 8, 9, 10, 11, all together in the housing market right now, which is making it very interesting. But I think that, as you say, 24 was a transition year, and we're going to see some things break loose and not in a way that I think folks want in 2025. And I really do see that as being the year we start to get some price discovery. You know, I think some people say, well, why don't you think it's just going to be like 24, where the only people that were transacting were the rich, and so you had that higher median price? I will say, number one, those median prices tracked by the National Association of Realtors mean absolutely nothing. They get revised away. They got revised away during the last cycle. And what's been happening is you can see it in their schedules, the increases in those very high dollar homes, which is why you have that higher median price. And because you don't have a lot of sales happening, it's hard to get price discovery. But as soon as we start seeing, you can see the listings, and I study 80 markets, and every week I actually look at the listings in those markets. And you can see so many price cuts in those markets. As soon as we get some of those sales, you're going to start to see that in the Case-Shiller, which has already kind of turned the corner and is starting on the way. It's seasonal journey down. It does this, almost every year. But I believe that's going to accelerate, and that series is going to be very interesting to watch, but it won't be the one to watch for signals. That is for sure. It will just be more interesting and something to look at in hindsight.
Well, considering it's a very bad lagging data indicator.
Yes.
As are the pending home sales because of the duration of the contract closings. I've got a funny feeling that the most important data to look at this year, and please, I'm throwing this out for your opinion. It's not mine necessarily. What do you think about watching the foreclosure reporting data, especially in those bad markets?
Well, I'm watching it like a hawk. And what I would say, John, is I wouldn't look at foreclosures. I'd be looking at 90 plus and 120 plus.
Okay.
Because they are going to do, as you know, and you said it already, they are going to do everything in their power to slow those foreclosures down. And if it's the state AGs will get involved, if not at the federal level. I mean, we are just now, the VA moratorium is about to expire. I mean, and so those will slow down, and they'll do everything in their power to keep those from happening. But what you're seeing right now in the buildup of delinquency is, yes, in aggregate, those aggregate Fed schedules look okay, but underneath that, you're seeing the buildup behind the dam. And what I mean by that is you're seeing more of the 60 plus, 90 plus, 120 plus days delinquent not be able to be rescued. And if you just kept your eye on 90 plus or 120 plus, you're going to see what's happening. And that 90 plus is at very low levels, but it has got a straight line trajectory up. And we're going to see more and more of those kind of fall over the dam of loss mitigation. And we've seen every June for the past 2 years, we've seen incremental increases in delinquency. And by June of this year, that's when I think actually distress is going to start to have some impact on the market. People really believe they can sell. I can see it in my client books right now where people call in and say, oh, I'm going to sell my house. I just need a little bit of time. What about a simple repayment? But they can't. And they're going to be very, very shocked because all they've been doing is watching mainstream media when their house does not sell. And so I believe by June, we're gonna start to see the lever of delinquency have an impact on the market.
And unfortunately, I think June is when we start seeing 8% mortgages.
Which would, I mean, that would be wild. And so I'm really, I'm hoping to have my full forecast out in the next 2 weeks. But there's so many levers, and so John, it's just gonna make things very, very interesting, in my opinion. And it's gonna, and if we get to the 8% mortgages, oh man, that will be absolutely wild.
Well, I think the fact that we're still talking about a 6% 10-year added on with the risk on residential, but what that will do to multifamily that needs to roll over along with the commercial situation. We'll bring Mr. Awesome up for that. Holy Lord, that's going to be a mess that this economy is not prepared for. So it will truly become an inflate or die situation.
Yeah, and something Mr. Awesome and I talk about a lot is, the builders are going to be in a whole bunch of trouble, as well as those people that took the buy downs, because again, date the rate, or you can always refi, or whatever, form of that message that the real estate industry always gives. If people cannot reset or refi those buy downs, that is going to be a lot of pain.
Okay, now I'm going to throw this question out. Which region or state, if you wish, do you think is going to lead the way as far as a warning sign? I honestly think it's going to be Arizona or Texas before Florida.
So John, so this is a running bet with my colleague Travis. And I have to say, based on everything I've seen and how much time I spent down there in last year, and just driving all around, it's going to be Florida again, unfortunately. But I will say that I think California is going to shock everybody, because people are in absolute denial about what's happening out there. And California is the biggest housing market. And so I think Florida leads, but Texas and California kind of have a spat about who comes in second. But the thing about Texas is that even though it's gotten crazy expensive, they still are getting some migration, whereas California is really not. And so that's going to be some. I mean, guys, we've just been feeding on narrative for years, and every person I talk to out in California, that it's got to be bad when you see just how disconnected they are from the reality of the market.
You're 100% right. And one of the things I'm seeing down here are distressed homeowners. I didn't get a chance to post my other pictures from Northport yesterday, but I'll just tell you right now, in addition to homes for sale, every home that was for sale by owner or had other options that was occupied also had cars, jet skis, and boats for sales.
Yep.
Which means it's a distressed market. And whenever Northport and Cape Coral become distressed, it's an indication that the hurricanes, the property insurance prices, and the property taxes are driving people to leave the state, which is why this year, has been one of the lowest net migration numbers for Florida in 5 years.
Yeah. What's so funny to me, John, just to mention this about narrative really quickly, my favorite chart to post on Twitter is actually the history of migration to Florida since World War II, because everybody talked about how much, was coming down to Florida. In reality, it had slowed over the past 4 years in historical context. So when we say this, and John, I think you put it very nicely at the beginning of the show, we are just about the data. We're not about the narrative. We're about debunking the narratives, but you need to see the data for yourself, because nothing you're seeing in mainstream media, if you're seeing anything, you're seeing a limited hangout, which means it's a tiny bit of reality, but it's meant to confuse.
I totally agree. And going with your discussion about the narrative, folks, if you're not aware how this works in Florida, by about next spring, all of the hurricane benefits, stalls, mitigations are going to run out. So if you don't have a job, you don't have income to pay your credit cards, your car payment, or your home, there's going to be a massive change in the bank's attitude towards your property. They can care less about your car so much. They'll do that last, but they want that home because they know that it's going to come back up at a later date with more migration into the state. So as Melody and I witnessed in the first crash back in 07, 08, 09, and we were there on the ground for it, when that stops, the banks come in, buy up all the properties, board the houses up, change the locks, wait until it gets better, and puts them all on the market at the same time. We're going to see the same playbook again. And it's been that way for 50 years in Florida.
And even longer.
True, it does go back to 26. You got a good point there.
Yeah, it does. And so, yeah, and I mean, you could, like, John, that you can go read Bubble in the Sun or Swamp Peddlers, and you can see pictures of exactly what you took pictures of in 2000, back during the last crisis, which was, those boarded up subdivisions are where they just bulldoze them. And so, yeah, has a very distinct pattern.
So what do you think is going to be your, do you have any other predictions for 2025? Because I think this is going to be a little bit more of an interesting year than a lot of people want to talk about.
I think it's going to be disorderly. I think it's going to be very interesting. And the person in me that hates to be wrong wants to come out a little bit conservative in my price forecast. But in reality, we have to remember how quickly prices rose this time around. And so I'm working on my final number, but I do think that 2025 is going to be disorderly. And I think that is when there's going to be realizations, and it's probably going to start out slow. Inventory will grow in the spring. And the levers, if the stock market continues its little jaunt down here, then all bets are off, because I think one of the only things that has sustained any buying this year has been the newly minted NVIDIA millionaires and the people that have been looking at their 401k portfolios and saying, you know what, I'm okay. It's going to be okay.
Yeah, and I just put a few pictures up in the MacroEdge Radio thread for everybody to sit there and take a quick gander at. A few more pictures. Gang, it looks just like 2008. And if that doesn't scare the living hell out of you, I don't know what will.
You got to see San Antonio and Austin, John.
Oh.
It's now just one big new build site. We could house a country down there, and it's all vacant and abandoned.
What blew my mind about it was the major builders are still building these giant subdivisions in a new part of Northport, in a new part of Cape Coral, in a new part of Sarasota. At the same time, there's 500 homes. And by the way, folks, if you think I'm kidding, according to Zillow, I use the Zillow data because it's something any schlub can go and look up. There were 3,137 homes for sale yesterday, not including for sale by owner. Let that sink in, folks. That's not a small number for a bedroom community, is it, Melody?
And it's a bedroom community. No, it is not small, John. I mean, there's no way that will ever be, occupied. And so, and so that's what's happening in Florida. But then you have to think that's happening all over the country. And people say, not in my neck of the woods. Well, I live in Johnson City, Tennessee, and they're doing it here in every available place too. And so you may think that, but take a little drive around. You will see that this new home construction has infected the entire country. Maybe not Stamford, Connecticut, or the places where you don't have any infill to build on, but it is everywhere else.
Well, Melody, I want to bring something else up because this is a subject we've been talking to, and I've given some money to these people. Why don't you talk about the recovery efforts in Eastern Tennessee and Western North Carolina? You've been on the ground firsthand. We've been having to deal with the Florida situation down here, which is still a nightmare. I was on Anna Maria and Holmes Beach this weekend for the first time in a long time, and it's not going to recover for another year plus. What's it like up there, please? Fill everybody in and how they can help.
It's hard. Anything I say is going to sound hyperbolic, John, because there are no words, pictures, drone footage, just to describe the damage here. And so I think that's going to be a big surprise for everybody in 2025 as well, John, that aren't familiar with what hurricanes can do to these markets. Is this event is going? We'll be able to look back in history and see that this event was very impactful to the economy, because so many of these towns were tourist towns And what you were mentioning earlier about high, taxes and you don't have a job. Well, what if you also lost your cash flow as an investor? And so many of these communities, like Asheville, had over 3,000 short-term rentals. If you look at Asheville, that doesn't make any sense. And so, what I'll say is that there is any coverage you're saying does not in any way adequately show what's happening here. And the destruction, I've been with veterans I've been touring with them doing search and recovery, and they tell me it looks worse than most war zones they've been in. There's a place outside of Asheville that looks like Baghdad right now, twisted up train cars. But that's just one location. You could drive 1,000 square miles of this area and find those places everywhere. And this is 7 states this impacted. And so I think that Helene, although we were already in a transition year in 2024, I think Helene, Milton, Beryl, Idalia, all of these, that whole impulse of everybody wanting to be a landlord, that will be gone in the next 2 years, because the insurance crisis is everybody, we've been talking about it. I started writing about it in 2022 after Ian, but now mainstream media, everyone else is waking up to it. And this is another reason California is in trouble. This insurance situation is going to make it absolutely unaffordable for landlords, whether they be big or small. And so if we don't solve that, there is no Wall Street coming in to buy, or even the banks at the end. I personally think, John, at the end of this cycle, it could be the government buying.
I would not be surprised, and I do look for the more creative states, that would be like Florida, to come up with a private-public partnership agreement to sit there and try and restore some of the areas. But at the same time, it's going to take an amazing effort, and no, I'm not endorsing FDR's policies, folks, but an almost 1934 WPA-like effort to restore Western North Carolina. If you've seen the infrastructure destruction up there, it's mind-blowing, absolutely mind-blowing. And Melody will tell you, it's a miracle that they finally gave the Amish permits to build homes, that they finally are getting some of the tiny homes up and running. Gang, this is not this is a situation. If you find, and I've given to Samaritan's Purse, I recommend them highly. They're on the ground, they're buying homes, they're doing whatever they can to help these poor people. Do what you can to help. If you're lucky enough and fortunate enough to be able to help these people, start off 2025 and contribute to the rescue efforts up there.
Yeah. And let me just say quickly, and if people want to DM me or tweet me, I can give you local people you can help directly. I love Samaritan's Purse. They've done great work. The problem is so many of these organizations are packing up and going home. And so now I've finally, after driving around everywhere, gotten in with 2 great search and recovery and teams and operations that are serving this entire area. So if you want to know somebody you could give to directly, please reach out to me. Otherwise, you can give to my GoFundMe. It will go directly to these folks, no admin overhead, and I'll give you an accounting of what happened. But, yes, I agree with John. If you are in any, and if you can't give money, guys, and you can give a weekend or anything like that, we'll take anything. And you can help from wherever you are, because we need people doing logistics. We need people answering the phone. Whatever, we need everything down here. So however you can help monetarily or with just elbow grease, we'll take it. We'll take anything.
Melody, may you and your family have a happy new year and a prosperous and safe 2025. I think we're good on hurricanes for a while. Let's bring on the snow, right?
That's right, which is that freeze is very concerning, which is coming later this week and into next week. It's going to, for the people in the hot tents here, it's already been pretty bad with the storms, but that's going to be pretty crazy, which is one of the other things I'm trying to prepare for and getting out propane and gas to everybody.
Amen. Thank you so much, Melody.
Thanks so much, John. Thank you.
And make sure you read Melody's work at MacroEdge.net, the REA sites. Melody, thank you. We're going to bring Market Wizard up now. Market, you there?
Yeah, thanks for having me, guys. I appreciate the chance to speak and share some ideas. Melody, thanks for everything that you just mentioned. I wanted to add on one little thing. Very interesting, not to go political, very interesting that there was a $25,000 first-time home buyer relief that was just talked about, right? Out of what was considered to be one of the strongest economies. So now that that's off the table, what are your thoughts really around getting new home buyers into the market?
So one thing I want everybody to understand is those programs already existed. In fact, if you were in Detroit, you could get $50,000 as down payment assistance. Like when they did, the big act and they sent all that money to the states and the counties, a lot of that money was geared toward down payment assistance. So that wasn't even a new idea, believe it or not. And in fact, there's $5 billion left in that fund that hasn't been spent. And so the only way, and you can see that the only way, because now NAR and Lawrence Young and everyone has pivoted, saying that okay, we've got enough inventory, and okay, prices might be a little high. In fact, I'm on Realtor.com's distribution list. All I'm getting are price drop emails now. And so the only thing, because even if we brought rates down to zero, unless the Fed came in buying MBS or things like that, there's no way we get rates to where it could really make a meaningful difference. But the only thing that can help first-time home buyers, which, by the way, were the lowest this year than they've ever been, is the prices have to correct, or we have to find productive jobs where they can make a living wage to afford this. And right now, I don't see those coming our way.
That makes sense. I completely agree. I mean, if you look at, like, I think I saw a stat the other day. I mean, can you afford the house you're in, right? I think it was over 50% could not. And if you look at the long-term averages of rates, I think it's 6% going back 150 years. We're 1% above that, and everything feels broken.
Yeah, it's crazy.
All right,
Yeah.
Market, are you ready to
So,
rip? What do you think's
yeah, man,
coming for this year?
So I first I'll give you the rundown of 2024. It was definitely still all about AI, and it was a quiet 30% correction in the semis over June, which is, if you look back, a very large pullback for the leading index. And then software stocks took over. But outside of those two sectors, right, there was not a lot of activity. There was really no rotation into small caps, no rotation into transports. We ended the year essentially, the best 2 years since like 98, 99, if I remember correctly. So, on mainstream media, right? You go to Wall Street, go to any of these financial papers. It's been the best 2 years that anyone can recall. Yet under the hood, it's really a concentrated rally. And if you look at, the top 7, 8, 9, 10 stocks, they're profitable, and there's a growth story there. That growth story is AI. And we could debate that until the cows come home. But the bottom 490, there really isn't a growth story. There really isn't, profitability, and it hasn't really been that. You really haven't had any growth or profitability since the rate hike campaign started, and so we ended the year with rates actually continuing their rise despite what Fed, Powell said. Comes out and says, declares victory that inflation has been beaten. I remember seeing that headline, and I always felt that as soon as he declared victory, you'd see the third wave. I think the 1970s analog is circulating everywhere right now, and from where I sit, that's got the highest probability of coming to fruition in 2025. The funny thing about correlations is they change on a dime, and all of a sudden, no one remembers the correlation anymore. For example, in 2022, everyone blamed the tech sell-off on the rate hike campaign. Well, rates have been hiking, and QQQ is still rallying. And if you look at just, the high level, You've got QQQ and SPY within 3 percentage points of all-time highs. A decent year again, right? The reality is the third year of the average bull is the worst. So from where I sit, I see a lot of chop next year. Does that mean there won't be any winners? Definitely not. I think energy is primed right now to have its next leg higher. And I still wouldn't count out the Mag 7. I don't have any evidence that they've topped yet. But outside of that, there's either going to be a large rotation that takes place, or they're going to continue to rally these same 7 stocks until there's no one left to buy them. And I don't know when that will be. I'll let the market tell me when that happens. And as
What do you
of
make of this
now, they're still
distribution?
buying them.
Well, what do you make of this distribution the last 2 weeks since the Jay Powell's blunder? Market Wizard, what do you make of the distribution we've seen the last 2 weeks?
Yeah, so that's a great question. I mean, they're still buying SPY. They're still buying QQQ. It really all comes down to SMH, the semis. It's the leader. If you look at my pinned tweet, they've been the number one leading indicator of where the market is going. And if they can break bull out of this triangle that they've been in for 6 months, then everything else will rally and everyone will have forgotten the 30% decline, right? At this point, they're still in the triangle. So it's, I love to say this, the triangle is designed to make both the bulls and bears throw in the towel. And that's what you're seeing right now. So there's really no conviction left from either side, right? If I look at who's been hit the hardest, well, it's IWM and IYT, transports and the Dow and the Russell. And if they can't take the rotation torch from semis, then this thing is just one big distribution pattern waiting for the last buyer to come in. And I don't like calling tops until we have evidence of a top. I think the master MSTR, right? I think they're done. I think Bitcoin is hanging around, which to me, I put it in that NVIDIA Bitcoin is the same trade. And we just don't have enough evidence that the top is in on either of those, right? It's been a long consolidation for NVIDIA. I think if you go back to June, they've basically gone nowhere. And then if you look at Bitcoin, to me, it would be hard for it not to be a top, given the sentiment that we see. But until we get that monthly reversal that's confirmed, in my sell signals on the monthly, I got to sit back and just say, well, this is a consolidation within the context of an uptrend for Bitcoin. But it's the same answer everywhere. It's tech, and then everything else they're just throwing away.
I tend to agree with you on Bitcoin. The reason I didn't make any predictions on Bitcoin this year, which I did nail last year, that it would rally above 65,000, no idea it would go to 100, is that I believe that the speculative frenzy is not over with, but I think, and I'm going to talk to Lawrence Leopard about this when we have him on our show. He's one of our guests in early of next year. Is that I believe that what we will see is a peak or a top in Bitcoin, at least an intermediate term top, after the State of the Union, where I believe for the first time in history, a sitting president mentions Bitcoin as a potential reserve for the American government in some form. That will blow my mind. It will also blow the Fed's mind and probably trigger some very nasty reactions from the insiders at the Fed. But that's just my opinion.
Yeah, it's funny. So I've been saying for the longest time, and again, there's no evidence to support this, that the U.S. government developed Bitcoin and that the goal is to replace the dollar. Now that that's the mainstream narrative, I question the validity. But yeah, and I mean, there's no doubt that Trump has made it very clear he is 100% in support of Bitcoin. I know his son and his family are all over it, so they're clearly speculating in that market. And again, they're going to suck every last bull in, and until we get that sign and signal, I have no other view but to say the trend is up, and we have no evidence that it's stopped, and that sentiment and momentum are accelerating higher. Right? I mean, you go everywhere, it's all they're talking about. I mean, I love watching golf. You had Scotty Scheffler and Rory McIlroy win this crypto tournament here just a couple weeks ago. $10 million prize. By the time they got paid, it was almost closer to $9 million. I mean, so I don't know how I don't know how anyone wants that environment, right? But that's where we are.
Okay, so welcome to the MacroEdge team, by the way. If you're not familiar with him, folks, he is one of our contributors, and he does offer some very interesting market perspectives that others do not. Market, what is your shocking prediction for 2025?
Ooh, that's a good one. So I either see the rotation into small caps and transports taken off, and you're going to have a breakout like you haven't seen. I think Art Laffer talked about it on Sound Money a month or two ago. He thinks that we're going to see a massive takeoff as soon as Trump takes office. Now, if that's the case, you should expect to see downside motion into the 20th on the transports, on the small caps, and that will be your buy signal, right? It will come right then and there. If that's not the case, then the shocking prediction is we're in for another 20 or 30% correction in the equity market. And again, the data that I'm leaning on heavily is how do the semis resolve? If SMH resolves lower, I think it's game over for the market. There is no, and anyone that's listening, go back test it. Go look for yourself. SMH has been around for 15, 20 years now. Find an instance where SMH was in a bear market and SPY, QQQ, IYT, and IWM were in bull markets. The answer is it doesn't happen. It's happened one time in 2018, and the result was a 20% correction across all asset classes. So it's one of those two. And until we get more data, I'm just going to sit back in cash and wait for the market to tell me what to do.
Fantastic. Happy New Year, Marker. Welcome to the team.
Thank you.
And can't wait to hear more of your perspectives and read them online. Folks, his name is Market Wizard. You can follow him at let me pull up a correct at. And this thing with Twitter, it could just be so much simpler, at MarketWizard87. And I know why you have to have the numbers. It's just the way it assigns them sometimes, or you choose them. It's crazy how it works, but that's life in the big city. Sir, have a happy New Year. We're going to bring Six up now. Six, how the heck are you doing, sir?
I'm doing good. About to pull up to my New Year's Eve party. Got a few minutes for you, though, John.
What do you make of this
insanity? I'm pretty excited for 2025. As far as it pertains to equities, the biggest things I'm looking at for 2025 are two different tails. The right tail, which is China beginning to come back potentially, and that's a tough one, but they're starting to have some of their surveys, bounce back above the 50 level and get out of contraction, and their stimulus is starting to accelerate. They're providing more and more liquidity. So the right tail for the markets really would be China rebounding and causing that higher wave of inflation, which, depending on how high rates go, could be good for the markets, especially the equity markets. A little inflation, they like it. A lot of inflation, they won't like it. And then the left tail, which would be the BOJ hiking. And they're kind of getting put into a corner here where they're going to need to hike. If they said they're going to hike, they want to end next year. And they said at their most recent statements that they think they're going to be able to get to the 1% funds rate. But, that's the last time they did this, the carry trade unwound, and, there's a lot of money in the top U.S. tech stocks that's wrapped up in that carry trade, and probably in many other places. They keep trying to put numbers on the size of the carry trade. The real answer is they don't exactly know, because it's not the easiest thing to track. You borrow money in Japan. It's not totally transparent where that money's going to go, but a lot of it finds its way back to U.S. Equities and rates for the rate differentials. But that's really where I see the biggest risks in 2025. The timing and the price of the markets is not. The valuations are getting really stretched, but if you've tried to short the market over the last couple of years based on that, you've had a really bad time generally, unless you were really good and really quick at getting in and out. But I think that the BOJ hiking in Q1 is a pretty large risk that the markets kind of forgot how what that reaction looks like in August. They've kind of wiped the slate clean from that. I'm not sure why dollar yen is as high as it is, frankly, considering that they're basically saying that they're going to do it. I don't know if they're all calling the BOJ's bluff or what, but I'm very close to putting on a pretty large yen long myself, but that's neither here nor there. And then the China story. I think that China, could potentially stage a large comeback in stocks now that everybody's been shaken out of that long position that they had. So I think those are the most interesting things to watch next year.
100% agree. I got a quick question for you. Do you think we see a 170 yen in the next 3 weeks?
I don't. I do not.
So you think they'll intervene at 160 again?
Yeah. Well, it depends. I don't think it would make it to 170. I think if it went over, and especially in the next 3 weeks, the speed at which it goes higher is something that they've publicly commented on being a real issue. So I mean, if it were to creep higher, they might not do anything. They'd probably still intervene before 170. But if it started to move in that direction that quickly, I would say they almost definitely would intervene. And then the rate hike and the hawkish speech from them would become more prevalent. Also, the quicker that.
Well, I got to throw one more question. Yeah, I got to throw one more question for you before you hit your party. I think you're right on China. I think China might actually let the renminbi or yuan deteriorate to an 8 on the U.S. dollar, and I believe it'll be a deliberate but step-by-step effort. Nothing dramatic, no overnight kind of crazy stuff. But you'd only be talking about, the first quarter if they did it in a phased movement. Is that something in your playbook for 2025?
Oh yeah, I could totally see that happening. If you look at when they started their stimulus, they really they weren't doing much except talking about it until the Fed cut. And now that the Fed cut, that's kind of their green light to start easing. And they've had some problems for a while now, and it really is time for them to do something about it.
All right. So what is your big prediction for 2025 without revealing everything you wrote for tonight's paper?
A huge unwind in the carry trade is what I think for 2025.
Oh boy. Well, there's your 20% market. that one would do it real quick too. People would not be prepared for that. 6, have a happy new year, my friend.
You too, buddy.
Kalani,
you too.
Welcome aboard. You're not going to get away with this. I'm way ahead of you on the Jamesons, and as you can see, I'm ready to smoke that cigar. So I want your market veteran perspective from being in the trenches. What do you make of this speculative fervor, especially when the owner of X changes his screen name to a meme coin and it shoots up over $800,000 in value in 6 hours?
Well, first, let me say Happy New Year to everyone, especially you, John.
Happy New Year, Kalani.
Regarding your question, honestly, I don't even have the words at this point. Some of the things that we've seen this year defy logic, or sense, you kind of insult my sensibilities in so many ways. I have nothing good to say about what you asked, so I'll just keep my mouth shut. Hello?
Okay. I'm sorry, I didn't want to spew my cocktail out in my phone. This is one of those that I don't blame you. We've seen this before, though. And I remember seeing a posting that I put up earlier in the thread for us MacroEdge geeks, and that was about pets.com.
Yeah.
I think we're at that level of fervor in the 2000, 2001 era. What do you think, sir?
I would agree with that. I think that, you know, when it's funny because when you asked me to chime in a little earlier, I jotted down a few bullet points of things that I'm watching and concerned about. And one of the things I listed was just the rampant malinvestment, fraud, and grift that we've seen, in particular this year, but it's kind of been ramping up for a few years. But in particular this year, it's unprecedented. The dollars that the level of malinvestment represents is astonishing. Whether you're talking about cryptocurrencies or, I mean, I consider short-term options malinvestments. I mean, just the things that we're seeing are unprecedented, much more so than 2000 or 2008. And while I should qualify that statement with saying 2008 had a lot to do with over leveraged real estate and banks and things like that, but the malinvestment is just obscene. So that's my answer.
So, have you ever seen when you were dealing with us in your trading days and stuff on the floor? On a serious note, have you ever seen anyone really sit there and pursue this craziness to the fervor that we're witnessing now? I mean, gang, we make a joke of it about fart coin, but let's take a quick reality check. The fact that a meme coin named after a human bodily function is worth $1 billion notionally is the most obscene, absurd thing I've ever seen. And if it's not the top, it's got to be damn close to it.
That's my sense too, but I mean, we've been saying things like this all year long. So, I just to clarify something you said, I was never on the floor as a trader. Actually, the first couple of years I was in the business, I was a risk analyst. So maybe that's what really frames my approach and my perspective to financial markets over the years, is that kind of early experience of being really cautious and learning about how to look at risks. And from my perspective, I see risk everywhere.
Well, that's what I'm looking at also. And I apologize for that. I forgot. That's what you started out as. And believe me, that gives you a much better perspective because you're looking at raw numbers. You're not looking at emotion or feelings or what Joe Trader says on the floor. You're just looking at the raw data and saying, this is insane. So I
Yeah.
totally understand that. Do you think this lack of responsibility by the various trading houses and banks is going to come back to bite us again? They won't feel any of the pain, but the average trader or individual usually does. Do you think we're getting ready to get a little bit of blowback from Mr. Market and the bear is getting ready to roar?
I hope so. I mean, people who listen to people, people who read what I post on X, or listen to bears in general, think that we actually want a market crash and bear market. I've never felt that way or thought that way. I don't want bad things to happen to people. That's actually why I'm bearish. It's why I speak up. I want to make people aware of the risks so that they can adjust accordingly, whether that's trimming a long position, or whether it's simply just hedging. There are so many things to do to protect yourself. And every cycle I see almost nobody doing those things, and it's concerning. So I don't know if that answered your question. If you want me to elaborate more, if you could, that'd be great if you could repeat it. I'm sorry.
No, that's okay. You hit it right on the money. I think that we've just created assets to gamble on, and that gambling mentality has spread from football to actual ping pong, believe it or not,
Yeah.
to badminton, which I've never thought about wagering on. And now stocks, equities, bonds are treated as the CLOs. They're treated as poker chips. And I think there's a real danger there. And as someone who's been in the risk side of things, you more than anyone would know. As a risk analyst, you don't allow people to sit there and play with poker chips that have zero notional value underneath and are just purely based on emotion.
Yeah, exactly. And I would argue, I mean, you used the word assets in the beginning of what you said. And I would argue that a lot of these things aren't actually assets. I don't care what the IRS designates something as, or even the SEC for that matter. They've been asleep at the wheel for a long time. I mean, when I worked in the business, we got audited at least once a year, and those audits were brutal. I don't know if that still happens because I'm removed from the business now and I haven't been in the business for a while. But the things that I'm seeing. I mean, Market Wizard brought it up, but MicroStrategy, I think, is going to be talked about for decades to come. It's when someone like me or Piker, who's in our group, has the gall or temerity to express some concern publicly on X about uh, the things that Sailor and MicroStrategy are doing and how it affects individual retail investors. I mean, when you see the blowback on something as simple as just a benign warning or post on Twitter, it, it's it's startling for someone to, with my background or any background in investments, to wrap your head around when all you're doing is expressing concern. I mean, we like to throw around terms, and I engage once in a while and argue back. But it really is cultish behavior, and we use that word, but the behavior that's behind that word is really concerning.
Well, Kalani, I appreciate your input. So I'm going to ask you the same question I ask everybody else. What is your big 2025 prediction that may be very positive, may scare the hell out of everybody, may get you in one of the new Gitmo prisons being constructed for people who disagree?
This is the honest truth. I don't make predictions, like, especially that far in advance. I think the market is just too dynamic. There are so many variables and so many unprecedented things that could happen in 2025 that nobody talks about. I mean, geopolitical risks. I mean, I like what Six said about the massive unwind of the carry trade. That could very reasonably happen in 2025. But I take it as it comes, and I adjust accordingly and quickly. So that's my answer.
Sir, Happy New Year to you and your family. Have a great 2025.
You too. Appreciate the community. Thank you.
Thank you, sir. And everyone, if you want to hear more about this, read more about this, macroedge.net/ozone, macroedge.net/ozone, and MacroEdge Resites for the real estate inside information you need. There is a 2-week free trial available for MacroEdge listeners and readers at the Ozone, macroedge.net/ozone. Take advantage of it today to read things like from the one and only, another one of our TV stars, Ulysses Awesome. Ulysses, how you doing, sir?
I'm doing very well. How about yourself?
That would be better if my headset was working. Of course, I didn't get a chance to test it before the show, so it took a barf. And of course, Amazon doesn't have 1-minute delivery.
Of course not, right? Of course not.
Of course not. At least I get a better microphone. It might make me look sexier on the air. So,
There you go.
welcome to the program.
Thank
What
you.
do you make of everything that happened this year and heading into next year, sir?
Oh man, 2024 was wild. Lots of different things in the real estate world. One of the record years of construction for residential construction spending and for units under construction. 2022 and 2023 were higher, but we were building so much that that contraction didn't really get noticed by a lot of people. But I think 2025 is probably going to be where we start seeing it be felt because we've got completions way outpacing replacement backlog. So I think 2025 is probably going to be a real soft year for construction to start things. We wrote about that in our weekend recites for the year end. And then, of course, one of the other things that's been huge has been interest rates continue to rise meteorically since the Fed cut rates. And I think that's going to put even more pressure on the space into 2025.
Do you think, as Melody, Amy, and the rest of us do, a lot of us do, everybody who's been talking about this subject, the danger from the blowout in the U.S. 10-year rates is going to be the story of 2025? Or do you think it's going to finally be the exposure of the poor investment choices of some of these developers? Because I am in shock from what I saw down in Northport and in other parts of Sarasota County. Please rant on about that one if you'd like.
Yeah, I think there's definitely going to be a lot of communities, especially in the Sun Belt and also in the West. A lot of people like to reference the GFC and the home building market and how that was different. But the reality was the South and the West was also leading the charge in deliveries, in the inventory that was out there then as well. And that's only grown. Right now, the Sun Belt or the South Census region is 60% of the new home for sale market. So, I mean, that's an enormous portion of the real estate market for builders. So they're heavily concentrated in there. Those rates increasing, it's just going to affect margins. Lennar's CEO came out and said that they're going to prioritize pace over price because they want to get to their sales targets, but they're looking at reduced margins. And I think as the first 3 months of the year go on, I do think we're going to have elevated rates. I'm not as confident that we're going to see the 10-year go as high as some of the calls I've seen lately. I don't know that it gets to 6%. I could see 5% being realistic, but you're talking about even more elevated mortgage rates, 7.5%, maybe 8% at that point, and that's going to it's going to eat into profit margins. So while they're forecasting they're going to be in the 19% gross margin range, I think there's a chance that first quarter is below that, and then that's kind of a self-defeating point for builders, where if their stock's already taken a hit on just guiding margins in the weaker fourth quarter, which we had both October and November come in with really weak sales, and December is not going to be any stronger, in my opinion. All the things going into quarter one are just going to make that harder for them to get out of that cycle. So I think we need to look for reduced margins. We need to look at it's going to be harder for builders to sell, and if that means that that's the majority in the South, that's realistic, but that's still 60% of the new build market. So you're talking about the majority of the new build market being problematic.
Well, the reason I'm following the T. Rowe Price logic on the 6% 10-year is different from everyone else's, and I think it's going to be because of diminished demand. If you're imposing tariffs on a nation, the incentive for those nations to buy our bonds diminishes dramatically. And I think there's going to be some payback for that. China will roll their short-term debt over all day long. If you're going to sit there and give me a 30-day or a 91-day bill and roll it over and give me 4.5%, you'd be foolish not to. However, when it comes to 10 years, if you're going to sit there and tell me, yeah, well, we're going to give you 5%, but we're also going to sit there and penalize you with higher tariffs and more restrictive trade policies, especially exports to your country, I think there's going to be some payback.
Yeah, it's entirely possible. I can see why anybody would want to have a larger rate of return on longer term money. I think that's just a logical and reasonable thing for one to expect. But then you add some of those into the equation, and then there are pressures there for that interest rate the yield on the 10-year just to rise even more. And of course, that's going to affect mortgage markets. One of the areas that I think that you might see some of that weakness show up in a couple areas that I haven't really heard much discussion about, but we've got warehousing in this country, so storage, even mini storage, warehousing. It's been an impressive run on construction spending for those over the last couple of years, but since 2022, we have doubled the vacancy rate for industrial. As of December, Globe Street just published, we're at 7.5% vacancy, and we still have a lot of buildings coming online going into 2025. So I think there's going to be some additional weakness showing up there, especially as trade routes and trade lines are adjusted. We still have a lot of bankruptcies happening in the trucking space. I know there's been some calls to say that the freight recession's over. I'm not positive that it is, and I don't know that we've seen all the fallout from those companies filing bankruptcy. I think that's going to be a continued weakness into 2025, and you're going to see some more pain in real estate there. If we get to 10% vacancy, by the end of the year, it's been a long time since we've seen 10% vacancy in industrial, and that's problematic from an investment standpoint. And there's a lot of it out there on the ground right now. I don't know if you're flying a lot recently this year, but you've probably seen a lot of empty warehouses, especially near airports, very big buildings, and that vacancy rate is just increasing.
Well, I just posted up another picture from Northport of another 20,000 square foot building on top of 4 other 20,000 square foot warehousing spaces being built in Northport off the exit. It's insane, and people are building more on top of existing vacancies. I think the vacancy rate goes up just because of the construction finalizing, and it's going to be a disaster for that particular part of the industry. That's just my 2 cents on this. I have been fortunate not to have to fly as much this year and grovel. It's mostly been driving to the East Coast to the builders over there and begging for mercy. So when you look at commercial real estate, is this the year that the multifamily has to pay the piper?
I definitely think it's a start. One of the things that I published in Resites for MacroEdge this weekend was a forecast for deliveries. We had an absolutely massive year in deliveries this year for apartments through November. Let me just double check, but I think we were at 585,000 units delivered through this year. Which outside of 1973, 72, and 74 is record setting. And the number that we have under construction and the months of pace that we're at to complete those, we're looking at another between 520 to 630,000 units coming online in 2025. So I've heard a lot of real estate analysts talking about, the supply glut is over. I don't think it's over. I think we're going to get the same amount, if not more, into the market in 2025. And I think it's just going to be a harder market for all of the units, whether it's apartments, whether they're single-family homes. Everybody that's not building to the very bottom dollar that they can is going to face more pressure. And that multifamily situation with commercial mortgage-backed securities already above 10% delinquency rate. I think 2025 you're going to see that increase even more. I think you're going to see more banks not being able or willing to extend on a lot of properties. But like all things, you're going to have ones that come on, they're going to do just fine. But I definitely think there's more distress in 2025 for the apartment market in general. And I don't think it's going to be limited to just Class A buildings, the nicest and the newest. I think there's a lot of syndicators out there that have bought up 1960s, 70s, 80s vintage apartments that need a lot of rehab and renovation, with the expectation that they're going to be able to cash out or flip those. And I don't think that's going to be as easy as it was a couple of years ago.
I tend to agree with you, and I think the thing that's going to really hit home with multifamily is the capacity has been, the open vacancies have been increased so dramatically. Uh, just a side story in my anecdotes of cruising around yesterday. I passed this brand new apartment complex, been open for 2 months, maybe 20% occupied. When I looked at the location and where it was built, the only thing it had going for it was right off the interstate. Unfortunately for the people who live there in Venice, if the wind shifts, you catch the dump 2 miles away. I don't understand some of the construction concepts of these multifamily builders thinking that they can just put something down because it's near an exit and it's instantly going to lease out immediately. A lot of what was the primary driver, and you can educate me on this, for multifamily, condominium, et cetera, real estate was location, location, location. Down here, it just seems like, hey, there's a plot of land. Cows used to poop there. Let's build a building.
I think that's something that is cyclical. Location, location, location is sort of it's a saying because there's some truth to it, right? If you have the best piece of property on the waterfront, it's probably going to do much better than somewhere a couple blocks away that doesn't have that feature. In expansionary cycles, especially the run that we've had for multifamily, a lot of that got thrown out, right? You've got developers that have been doing this a long time, and that's their business, and a lot of location is going to be specific for them as what they're looking for in properties to build. One of the things that has sort of changed Trump's last administration, we got opportunity zones passed. And opportunity zones are designated census tracts in the United States where developers can basically get deferred taxes for developing, reinvesting proceeds that they had and avoid capital gains if they hold for 10 years. So a ton of apartment buildings got put into opportunity zones and built there. Some of them are going to be great. Some of those opportunity zones, it's exactly what was needed there. There's going to be plenty of good ones out there, but there's also a very large portion of those that I think you're going to have troubles with. And to your point, a lot of those are in areas where they might be next to something that is not a location preference, and those are going to struggle, especially if there's better alternatives for the price point or the age of the building itself that have been built over the last few years.
I've noticed something else, and besides,
If that makes sense to
no,
answer
that makes sense. My only thing is when you talk about on the water, not such a hot idea in Florida.
Can you hear me, John?
Yeah, but in reality, I think you're right. I think we're going to see by location.
Show of hands, can anybody in the audience hear me?
No, you sound good, sir. You sound fine. Let me tell him that message. I wanted to send him a message so he knew he could hear it when he was being heard. Mr. Awesome, to be honest, I think that you're correct on that part of the location, but I'm beginning to think that some of the locations in the South and the West are going to be very hard to move, and they were built in poorly chosen future locations, perhaps 10 and 20 years down the road. I just don't think the next 2 years is going to be very kind to migration into our region or into Texas for that matter. Uh-oh. Now am I being heard? Well, here we go with X doing its thing again. Can everybody hear us? Okay, I can't tell if anybody can hear Mr. Awesome or not. He's reconnecting as we speak. This is one of those situations with X that we're getting used to. The problems that we're enduring with X Spaces is something we're all analyzing. We'd like to stay here. I'd like to think that Elon's going to put some money into it and really invest in it. Just not sure. In the meantime, Kenny, if you're ready, we will bring you up into this conversation. Oh, here he comes. Never mind. I got Mr. Awesome back now, finally. If I can get this stupid thing to work. There we go. He's coming back on. Kenny, if you've seen your request, go ahead. We'll get you back onto this list too. Unbelievable. Yeah, this is what happens with live radio and X Spaces, folks. It takes, I hit the buttons, It comes back. It's sort of weird how it sits there and dilutes everyone. It takes everyone's conversation, distorts them, turns them off, turns them on. It's very, very frustrating. And it's one of the reasons we sit there and try and just deal with this on a one by one basis. Um, I don't really know what to make of it, to be honest. It's a shame because it's fairly simple technology. I was able to sit there and deal with it using a dial-up telephone at one time back in the mid 2000s and broadcasting around the world. So this is bizarre that we can't accomplish this. Kenny, I'm waiting on Mr. Austin to reconnect. So in the meantime, how are you doing, Kenny?
Oh, John, I'm doing so good. It's stupid. How about you?
I'm trying to get stupid right now. For everybody who doesn't know, Kenny Capital is one of our writers on the Recites team for MacroEdge, and his latest piece is on this past weekend's prediction thread. Kenny, what is happening in Nashville and what's happening in your part of the world as far as real estate goes? And we'll get Mr. Awesome to join us as soon as the damn thing lets him connect.
Yeah, so really just kind of more of the same. It's homes. If you're in the market to buy a home, homes really just aren't selling. Depending on what part of the metro you look at, it's prices are flat or maybe marginally up since 2022. It almost kind of looks like a double top, if you want to do some technical analysis on it. But just in general, like the way that I look at not only Nashville but these other markets, I'm looking at it from more of like a structural standpoint, and like what the demographics look like, what does the labor market look like. And a place like Nashville, especially like city center or Davidson County, that's the most populous county. It's extremely like structurally oversupplied. So if you look at that in terms of like housing units per capita, there's just way too many homes. And I think that's kind of like what we're grappling with right now. People are just kind of hiding, a lot of these speculators. So I think it's going to take sort of some undeniable like weakness in the labor market for a lot of oftentimes these just people who are like these financially illiterate speculators to sort of see the writing on the wall. We're just kind of like right there, and I see that not only in Nashville but really kind of all over the country, and it just maybe looks slightly differently. And maybe one metro has a different profile than say another one, but there's still these like common themes that sit under them. So like, the average household size has gotten really small, and you tend to see that in the good times, like when people have jobs or whatever, they can go out and they can get their own, apartment or buy their own home. But that tends to sort of reverse. And there's a secular component to why it keeps going down because, we're just older as a population. But you're already kind of seeing signs that that's kind of unwinding. And this is on the back of all of this, new construction, especially you see that in the Sun Belt. But you can't necessarily like write off some of these quote unquote stronger markets like in the Northeast because they have some of those same characteristics. It's just, like maybe the population isn't growing, but they still have like a lot of homes per capita or homes per households. So it's just, we're kind of in this, whether I talk about Nashville or just, mini metros, we're kind of like in this holding pattern where we're just trying to kind of like figure out, okay, like, who's going to make the first move? And look, people will have this really sort of like wonky idea that somehow incomes are going to catch up to these prices in a softening labor market. And especially when you've already had for decades they've existed, dual income households. People act as if that's like a new concept. That's just wrong. Okay. I don't know why people keep bringing that up. It's just dumb. I mean, there's all these things that they track at a very granular level. But people still talk about it as if it's a thing. I mean, DTIs would reflect something like that. So, it depends on, I guess, like how the administration responds to all of this excess supply. But if they were to let it work, sort itself out, I think it would be obvious by, I would say, Q2 of next year that there's just a ton of structural supply out there. And if you have smaller households in the aggregate, that's just fewer earners per household. That's not necessarily a good backdrop for home prices to remain at these levels, broadly speaking.
Well, let's bring the big question up here. With what's going on with STRs down here, the short-term rental market, are you starting to see an impact on the STR ownership up there finally?
Yeah, it's been going on for a while now. I mean, you have, and Nashville is one of those places where we actually do track short-term rentals, like officially, even though there's a ton of illegal short-term rentals out there. I mean, you can look at like, reciprocal population and kind of back into sort of an estimate of how many illegal ones are out there. But yeah, I mean, you're already seeing it, because if you think about like where those short-term rentals would be located, they're going to be concentrated near downtown. It's oftentimes new construction or newer construction. And, I have access to the, local MLS, and you can read all the remarks and everything. And oftentimes you can cross-reference them. And, these properties are being listed for sale, and they're being marketed every which way you can imagine just to move them. If you look at something like leisure and hospitality employment in Nashville, I mean, it's been negative for, 6-7 months at least, year-over-year growth. So, look, I know people love to look at a few blocks of downtown Nashville and assume that everything's fine, it's booming and everything, but that's just not the case. Not every consumer is the same, right? I mean, if you were to think about who would be coming to a place like Nashville, I mean, you can sort of paint the picture, right? So, yeah, it's not great. That's for sure. So,
well, I'm going to throw two big questions out at you. Number one, what does the region, because you're in that region, I'm not there with my ears on the ground anymore. I don't travel up there anymore. What is the interpretation of the impact of the proposed Honda, Nissan, Mitsubishi merger? Is there some trepidation in Smyrna?
I'll be honest with you, John. I'm not the person to ask.
Okay, I had to ask.
Yeah, no, I mean, look, it's funny because I pull the QCEW for like some of those more southern counties in the MSA, and you are starting to see a big drop off in that related employment, but of course it comes with a lag. I used to know several people who worked out at Nissan at their corporate, I guess, North American headquarters. I wish I had more connections there now, but I mean, there are many ways of sort of backing into like whether or not the employment data is remotely accurate or what have you. And you can pull like retail sales data, and I think people have like started to realize this. You can pull it at a local level. Okay. And they cut it just like they cut it at the national level. I mean, something like auto sales, I mean, that's been negative for several months, and it's only, at the county level current through June of 2024. So, of course, you're going to see softening employment as a result.
Okay, and now the other big question. What is your big prediction for 2025? Or do you have a dartboard, or we'll assume you're playing quarters? What is your big prediction for 2025, sir?
So, and this is there's a big like caveat here. Assuming there is no hand holding, this coming year, because there's just been so much of that, with BTFP and everything else. Assuming there's no hand holding, I think that even first off, just broadly speaking, there's going to be less talk about just this quote unquote housing shortage. And I think first off, we need to define what that is. A lot of realtors say that they're basically just referring to what's for sale, and that's not the housing stock. Those aren't the same thing. What I'm talking about is a structural housing shortage. You cannot find that just about in every market. You're just probably not going to find that. And more specifically, I would say like in the Northeast, a lot of these markets up in the Northeast where they've been, especially if you just look at what's for sale and all that, low inventory and everything else, they've been, we'll call it relatively strong. But if you just look under the hood at like what the households look like, who lives in those homes, it pretty much looks like a lot of markets. So you do see a lot of oftentimes older households that, or maybe like widowers or whatever, or it doesn't even have to be like a place like, New York City, there's a lot of like one person households. Well, if you have an area of the country or a lot of these metros where there's a high concentration of one person households, if that one person loses their job, you got all sorts of supply, right? And that doesn't happen overnight, but that's just kind of how that goes. So that's, assuming no hand holding, as long as the labor market continues to deteriorate, and it is. I mean, if you look at QCEW numbers through June of 2024, you're talking about, I think it's like 0.6% year-over-year private job growth. That is textbook recessionary, and that's not something that just turns around on a dime. I mean, it's going to take a lot to turn that around. So yeah, I think we're going to kind of get away from this idea of hopefully that there is a quote unquote housing shortage. Because if you're like me, I'm sick and tired of hearing about that because there's no math that supports it whatsoever.
Kenny, thank you so much, and we look forward to your next contributions to MacroEdge Resites. Gang, this has been the MacroEdge Radio number 34 Macro Dance Floor Marathon. We hope everyone appreciated listening to our team. We're going to wind it down now, begin our New Year's celebration in style, or cook dinner and then just go to bed like some of us older people do. But that is how we do it, and that's how we roll at this point in time. For MacroEdge Radio, this is John Galt speaking. Don't forget, go to macroedge.net/ozone. Get your 2-week free trial. Check out Resites. Happy New Year and good night now.